Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, September 17th. It is 12:57 p.m. The point of this video, I want to do an update on the commodities, the agricultural commodities in particular. Actually, you know what? Take that back. I'm going to rifle through my watch list in just whatever order I have my commodities. So that'll hit on natural gas. I had a question on that today. I'll talk on crude oil real quick, but mainly the ag commodities. That's where my focus has been. Before I do that, just a quick update on the market. Since the last post, we had a little bounce there. I mentioned that would be an aggressive, shorting up where you can scale in. Again, if that's where you think things are going, and if you're of the bullish persuasion right now, same story. We have this boxed-in trading range, and you buy at support. It's TA 101. Buy support. Or if you're going to short, you want to either buy a rally into resistance. I'm sorry, sell a rally into resistance, which there's a gap backfill. There's a top of the trading range. It's worked a couple times so far. And again, long traders, if you think we're going to new highs, you just buy here with stops below, and you can strategically add if it has these resistance levels, the same ones that a short side trader would use to add short exposure. You can add your long positions if that's taken out, because TA 101, if you're bullish and going for long trades, it says either buy a breakout above resistance, which would be that top of that gap, then the top of the recent trading range. So there's your objective long entries for long. Just like short traders will buy pullbacks to support. Oh, I'm sorry. A long trader can also buy a pullback to support as well. So a break above resistance or a pullback to support when you're bullish and going long. And then in reverse for short side traders, what I was trying to say is you wait, you don't short a pullback to support like this morning. You wait for either a break of support or a bounce into resistance, or in the case that I posted that update this morning, I thought that 1.25% or so bounce was an objective to short, because I didn't think we were going to run all the way to make a backfill. I'm expecting a breakdown, and here we are. So we reversed, give you a better entry price, and we're tapping there again. It's just showing a lot of weakness in the Qs. We still haven't taken out that support, but if we do, you guys know where I think we're going. And again, that's really at this point in time, a minimum target if we get an impulsive breakdown through here. I can zoom back out to the daily charts, weekly charts, and make a case for more downside, give you additional targets, but that's not the point of this video. I've already done some long-term analysis recently on the markets. Let's get back to the commodities. I just wanted to show you again where we're at. They stepped in and bought this pullback to that level once pretty aggressively on NQ. They did it again with the divergent low. This time they stepped in and bought it, but it didn't go very far, and we're already back there now. Now, they didn't take it out yet. Support until broken, so maybe they could step in here and buy. But if they take out the lows by much, we're probably going to have a pretty swift drop to the tune of about at least 5-6%. Okay, and although trading the equity markets, it's popular. It's popular for many reasons. People like to follow the stock market. People like the liquidity, of course. The fewer things are more liquid than the index tracking ETFs and futures contracts. So they're very popular trading vehicles for that reason alone. But we're going to go back and focus on the commodities today. I haven't done an update in a few days. Let's do that. Again, no particular order. I'm just rifling through my watch list. I'm going to tell you, start out here with really the near to intermediate term outlook on each of these. Time permitting, I'll jump over to the weekly charts and then give you the bigger picture. So this is BAL cotton, the cotton ETN. And it's walking up this uptrend line right here, and now we do have some divergence. I'm going to pull this line down. I had a divergence line drawn if and when we get to 41.45, which we may do, but we need to recognize there are negative divergences in place now. It's been a nice run off the lows since April. Cotton's rallied about 40%, 41% there, and it's at resistance as well, the 39.26. These are all levels I've had on my chart for a while. It's kind of the trend line. There's been a few dips below it. Remember, these ETNs, they do a pretty good job, not a perfect job, of tracking the futures contracts. If you're serious about trading commodities and you have the experience and the capital, futures are usually the better way to go. But again, there's nothing wrong with these. They do a pretty darn good job of tracking the underlying. And so again, if you're not ready for futures or you just prefer ETNs for whatever reason, you can use BAL. So that's it. Got to watch that. If it pulls back, I need to add a little support level here, and you can see the other support levels below. Reasonable to expect a pullback to at least 31.46 and even 34.79 on that one if we get a pullback. And for most of these, I still remain longer term bullish. So on the ones when I'm pointing out levels where it's maybe not objective to be adding long exposure if you're not already long, or if you want to try to game a pullback, I'm not so crazy about that when I'm in a security that's in a primary uptrend that I think is going longer. Sometimes I'll game a pullback. It all depends on what the security is and how much I think the pullback is and how likely it is to happen. But sometimes when you have a bullish trend, you get these sell signals and they only play out for a very small move, and then you get the buyer stepping in for the next leg up. I don't want to spend so much time on cotton. I don't know why I did. It's not one of my favorites at this point in time. Again, where it's at, it's already had a nice move. SGG, sugar. Pointed out there are 2 ETNs out there that are liquid, or as liquid as it gets. Some of these, a lot of these ETNs aren't super liquid. I usually suggest using either limit orders when you buy and sell these, or I don't know if other brokers have something similar. Interactive Brokers has an order type called an IB algo, and so if you put the order in, if it's trading at 39.70 and you put let's say a buy order in, it's going to fish around. Their algo programs will fish around between the bid and the ask and try to get you the best fill. I like to use that for your securities that don't have a tight spread, 1 cent spread. I'll use those IB algo orders. Last time just to recap sugar, we had a bullish, nice positive divergence down here, breakout of this steep, clean, bearish rising, or bullish falling wedge pattern, bullish falling wedge pattern. I don't know why that was a tongue twister. And just a nice clean uptrend since, zigzagging higher. Still heading up here, I think. In fact, most recently pointed out, just like cotton and a lot of these recently, I said, look, we've got some uptrend lines. We're overbought. We have negative divergence, everything else. Yes, it's a bullish trend, but you have to respect these divergent highs and divergent lows. That's a big part of my trading. And then we had a sell signal here, and we had a pretty healthy correction in sugar, pulled back about 5.5%. And then I mentioned it would be an objective long entry. I said, look, that's a correction, it's a breakdown, but we're in a primary bullish trend, so I don't expect it to go much further. Set objective long entry here on the intersecting $37 price support plus a downtrend line, and boom, that was a nice entry so far. You can see the impulsive move up, and that could be the start of the next leg up to that 47-ish target. CANE, almost the same thing. It's just a different ETN company. You had the uptrend line here. You had the divergent high right there, or a little wedge pattern the way I'm drawing it with the blue lines, and you had a breakdown, but again, bullish trend. So there's one that normally if I see a wedge like that, I'm looking to short, the measured target is the widest part of the wedge when you trade a bearish rising wedge, but I wasn't looking for that. Now I'm open to that possibility, by the way. Look, as of now, let me show you one scenario here, and this is why convictions aren't super high on the next leg up having gotten underway. You had the bearish rising wedge, you had a breakdown, right? You hit support and bounced where we should have. That's what I mentioned the other day. I back tested this trend line, and now we're back testing the wedge. So if we're going to get a little more downside in sugar, then we may get a move all the way down to that 558 support. If we do, I can tell you right now, I think that's an objective long entry all day long with a stop somewhat below. It would also come in with another back test of this trend line here. However, that may not happen because the trend has been strong in these commodities. And I can make a case, a lot of these for longer term bottoms, and so therefore, just like the stock market, when the bullish trend is strong, pullbacks get bought up, bearish setups tend to fall short of price targets. God knows I saw enough of those earlier this year on some of the trade setups we had, underestimating just how much juice the Fed pumped into the market. But there it is. So CANE, look, there was your objective long entry. If you took it, it's this simple. If you exited your longs or you didn't have anything, no matter where you are, you may have bought back here on the inverse head and shoulder breakout. You could have bought anywhere along the lines, or you may have just bought here for the first time. If this is where you bought on that pullback, that's simple. At this point, I don't know if I'd raise stops yet, but I'd keep stops. I'd raise them to at least entry at this point. if not higher, and let it run. See if you can take out this. I think it'd be a big move if it can take out that 620, 625-ish level right there. Open the door up to about $7. Cow is a little complex because it's an ETN comprised of two different things, live cattle and lean hogs. And they're similar, related, but sometimes you have an issue. Maybe there's hoof and mouth disease going on. The cows are getting put down, or swine flu, or that's like it's for humans. But whatever it is they're two different futures contracts wrapped into one ETN here. And they've been moving up, and surprisingly, they've been steadily moving up along with the grain prices as well. So what I'm seeing is a broad-based rally in the agricultural commodities, and again, that's where I feel comfortable with some longer-term funds there, and have for a while. Like I've been saying since back here, I think the risk reward is infinitely better than the stock market. Doesn't mean the stock market can't go up, but it's just all about risk reward and everything else. UNG, okay, UNG, I posted an update today. I'll grab that chart in a second on the futures, but I'm not going to get to the timing indicator. I had a timing indicator that kicked in right about here, right about when it bottomed. Annual cycle line showing that that's more often than not right around this time, this point in each year, we get a nice rally in natural gas, and we sure did. It was over 50% or so. About 64%, and we fell just shy of this target. Now remember, this is UNG, this is an ETN, it is not the futures contract. Professional traders are trading futures NG, and I'll get to that chart in a second. So for all intents and purposes, we came close enough there, and I warned of it at the time. Hey, risk reward is no longer favorable for adding, because risk reward is all about how much reward you're getting. If you bought there at 1452, or actually it got closer, 1455 for a move up to 15, because remember, you always want to sell a little bit before the actual resistance level. You're talking a 3% upside. You're going to risk 3% for what just happened, a give back of 20, no, so 22% drop. Now where we're at now, okay, we're coming up on on the reply I made in the comment section. So didn't have a super strong opinion, but I'm kind of leaning this way. We have support here at 1090. We have an uptrend line right here. We're not oversold on the daily, but we are near-term oversold on the intraday charts, and I think that's where the buyers are going to step in. So if you want to, you could start scaling in here early. If you're trying to nail the entry, I think we might get a little more downside here at about that 10. I'd step in a little shy of 1090. Let me show you why. Let me show you the NQ chart that I posted. NG, I'm sorry, natural gas. Here it is. Okay, this is a natural gas 60-minute chart of the futures. All right, story was, besides the case for the bullish long entry back here and all that, recently I was pointing out here we had an uptrend line in negative divergence. That's just a big old bearish rising wedge. It's a 60-minute chart. There's your divergent high right there, and boom, there was your sell signal. Breakdown, back test. So if you didn't get out on the breakdown, it gave you an opportunity to get down, or get short on the breakdown. There's a back test. Floundered around, hit that, danced on that 392 support level, and broke it. Fell to the next support ahead, which is 2.231, and had positive divergence there too. So this is where natural gas had a chance to power on up to the next high, but it didn't, and that's actually a lot bit bearish. And it's exactly what I'm talking about in the stock market right now, where this 60-minute divergent low should have been the catalyst for the move up to the next high, next leg up to take out the recent highs, and it didn't. We did get a rally out of it, but we ran into that 392 resistance level, got checked there several times, failed, a lot like the the recent trading range in NQ. Check, 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 third check, that was it. Ran down, and it's looking similar to what we're looking at in NQ right now, except only 2 tags. And then look, we did have a muted bounce here. I'll zoom in a little bit for you. A lot like what I think is happening in NQ today. When we hit it again, we bounced a little bit, but that was it. And then the seller stepped in, sold it as soon as they took 223.31 out. boom. It wasn't just a limp down, it was an impulsive leg down, and that's kind of what I'm looking at, something like that in the Qs if we get that breakdown below today's lows. All right, so where do we go from here? Well, that's, it kind of helps to study what has happened. Where do we go from here? Well, what I said in my reply on that when I posted this chart is this may be, it very well may be a momentum fueled overshoot of the 2067 resistance level. It's not a super strong resistance, but there's a reaction high there. It's a line I've had on the chart, so maybe we recover that. However, I'm leaning towards a little more downside, and that would correlate with what I just showed you on UNG. It's a little bit better support down here. You can see all these reactions back here about the 1.952 level. Again, step in a little bit early. Don't have positive divergence, don't have anything remotely close to sell signal. In fact, we have impulsive selling right now, but we are quite oversold, very oversold on the near term on the 60-minute chart. So there's UNG. Time permitting, I'll jump to the longer term chart and show you the bigger picture on that. Next up, palladium. I think the downside potential, profit potential on a palladium short is very high right now. If we get this sell signal I'm about to show you here, these are old trades and all that. What stands out to me is this nice cleanup trend line. This is the ETF, PALL, holds physical palladium. Look at how well defined that trend line is. And right here, you have your divergence line. There's your negative divergence. Palladium, when it moves strong. The trends are strong. Last time I pointed out a divergent high on the daily chart was right here. From there, palladium, PALL, fell 49%. So whether we get a 49% drop or not, I can tell you that a break below the trend line, a solid break, would be an objective short entry. I would like to confirm that with the charts of palladium futures, which I'm not spend too much time because I wanted to really focus on the ag commodities. I'll take a look at that, and if I see anything interesting, maybe I'll post that below this post in the comments section. I'll put a chart up of PA. Those are the palladium futures. USO has been a dead money trade for a long time. It was, like everything. There was a reinflation trade from all the extreme oversold conditions off the April. Well, actually, it was April where it bottomed here in USO, but mostly just sideways trading now for many months. I will say that if, and again, it's always a big if the stock market does break the support I'm looking at, especially on the Qs, and we take another leg down, at least 5-6%, maybe more, crude's going to be a nice short because that will almost certainly, crude tends to trade in line with the equity market. Sometimes it's doing its own thing, but I think you will get more bang for your buck. So some of the things, I'll just say it right now, if you're bearish, some of the things I think you'll get more bang for your buck. In other words, will drop more than the stock market, even the NASDAQ 100. Well, first of all, I think the NASDAQ 100 will fall more than the S&P 500. And then individual things that should outperform: crude oil to the downside, VXX to the long side. We have an active trade there. The VIX should go up, explode higher, I think, if we have a sharp leg down. Tesla is going to fall more than Apple and Amazon and everything else, although the FANGs will probably, just like last time around, have another big, come under pressure. And that's it. That's some of the things I think, again, will be that you might want to mix in there. But they're kind of correlated, so it all depends. If I'm wrong on the next leg down, then maybe Tesla holds up, crude oil holds up, et cetera, et cetera, et cetera. But I just wanted to point that out, that crude will most likely, and it's had a heck of a kickback rally too, and that's another reason I think there's a game of catch-up to be played on the downside if and when the market break takes another leg down. And look, it's rallying right back to that 41-44 resistance level. So let me just be clear right now, there's an objective short on crude from about right here up to, but not much above 41.50 or so, with a stop a little bit above that. Oh, kind of go off on a slight tangent, but somewhat related. If that plays out, if we get the other leg down, we get a big drop in crude. Remember, crude is a competing or alternative energy source to coal. Coal stocks have been very strong. They continue to be strong today despite the market weakness. Nice follow through on some of the breakouts. But I made this reply in one of the comment sections today to someone that was saying, hey, BTU is rallying hard today. Yeah, BTU broke out and it's running. It's one of the coal stocks I highlighted. But number one, They are coal stocks are sort of an obscure, small sector. The smaller companies they fly under the radar, and a lot of times during corrections in the market, those obscure little niche sectors can rally because they don't have a high correlation with the stock market. But on the flip side, if we get a broad-based sell-off, a very impulsive, one of those sharp drops in the market day after day, indexes are falling 3-4%. What happens is you often get forced selling across the board. Margin calls start kicking in. In fact, one reason that I'm keep calling for this swift drop, I think there's going to be another round of selling, and it's going to be largely margin based. About a week or two ago, week or so, maybe 10 days, right after the big drop started in the NASDAQ 100, a few days afterwards, I got a message from Interactive Brokers. That's where my primary trading account is. I've used different brokers, but they sent out what they often do times of market volatility. Hey, guess what? We're going to tighten up margin restrictions, margin requirements. So that means, let's say you're an active trader and you've got a $500,000, million, whatever your portfolio is, doesn't matter, 10,000 or 10 million, doesn't matter. Active traders will often use margin, trade on margin to enhance their returns. You don't have to do it for pure risk reasons. If you have a $100,000 portfolio and you're putting it all in NQ or gold or whatever, you're taking a huge risk. You're not diversified. That is wrong in my opinion. However, what I like to do is use margin to diversify and spread things out, spread my bets. A little gold, a little stock market, index ETFs, individual stocks, different sectors, and that margin helps you buy more things which are uncorrelated or maybe inversely correlated and diversified. But with that being said, where I'm going with that is there are a lot of traders that just concentrate, and I can tell you that now, a lot of retail traders just buying tech. Tesla, Apple, Amazon, they were jumping all over. They couldn't get enough of that new Snow IPO yesterday. And those traders tend to buy on margin and they're not diversified. And so if you get the big drop, you're going to get the forced selling, and what it is, it's a vicious cycle because those that are loaded to the gills in Tesla, for example, they might not want to sell it on when it's down 10-15% in a day, and when it's down 30% after a few days, like it just dropped recently. But guess what? They don't have a choice. Their broker says, sell now. Your account's deficient in margin. You either come up with new funds, wire funds into your account, sell Tesla, or we're going to sell it for you. That's how margin calls work. I just want to let you know, and that's what happened in the fourth quarter of 2018. It's what happened after the February highs into the March lows. That's where you get those waterfall type sell-offs. It's not all natural selling. A lot of it is forced margin selling, especially after an extended bull run, because that's when margins tend to be at their highest. Margin balances are very high, and we're just coming off that now. So make no mistake about it. We had obviously a little check here with this first drop, but if I can tell you without even looking at the margin charts, I've done this long enough, that when you see a rally like this and all those sentiment measures like I showed you on the put to call ratio and everything else, it tells you the masses are extremely bullish, thinking there's no risk in the market, and so margin tends to be very high. And yeah, that probably pulled things back a little bit, but I don't think that drop was enough to clear out all the excesses in sentiment and everything else that built up here. So we could be looking at one more good leg down, and we'll see. Okay, back on task here. Next one up, soybeans. This is SOYB, and another beautiful looking chart. It's been just strong. We put in, just to kind of recap for those new to the site, we put in a divergent low back here. DL means divergent low, which means positive divergence, when your indicators are making, momentum indicators are making higher highs and prices are making equal or lower lows in this case. And then this is our breakout right here. There was our buy signal on the break of the nice little downtrend line. We've been zigzagging higher. Once that started, I pointed out this uptrend line as objective place to add long exposure, and that was the last one back there. I pointed out the time, and boom, soybeans has not looked back. Now, here's one today I'd be booking profits on, or at the very least tightening stops up on. Why? Very solid resistance. This has been a long-term target I've had since back here, $16. We just hit it. Here's our uptrend line right here. Very clean, well-defined, and also very steep. And look, we hit that 1602 target almost to the button in reverse. So I think that in the very near term, the risk reward is not good. In fact, favor a correction. I think this trend line will break. Primary trend is up. I'd be looking at this point. In other words, I would not be adding to soybeans at this time. And if you've participated in what's been since the breakout alone, a 17% rally, you might want to either take profits or tighten stops. Now, sometimes these commodities can run. That's why you can raise stops, and maybe we break 16 and we head on up here to the next target around 1683. I do think that target's hit. It's just a matter of when do we get there and how do we get there. If we break the trend line, we're probably going to pull back, and I can show you right now. Here's an objective entry. I'm going to draw these lines out with the blue tool. All right, the blue line, here we go. No, well, I'm going to leave that one there. This is the one I meant to grab right here. Downtrend line plus this was a target resistance zone here about 1538 to 1523. So you have intersecting downtrend line plus price support, and that's what we could see there, something like that. That would be an objective entry. If there is a pullback and it gets even uglier, I'd like to really see that contained, and it's certainly possible to see a pullback to 1485. And again, maybe we continue on up, but again, just not objective to add at this point in time. More objective to be taking some profits. Also note the extreme overbought conditions. Soybeans hasn't been this overbought in a long time, and this is also indicative, by the way, of early stage bull market price action. In a bear market, you hit over, which we have been in a long time for soybeans. You hit overbought, and it's usually one and done. That's it. Get out, take your profits, because in a bear market, overbought rarely stays overbought or exceeds that 70 level. In a bear market, oversold often exceeds the 30 level, right here, the 30 oversold level, or stays oversold, I meant to say oversold, for an extended period of time. So this is bear market action here. And this is this is bull market action, early stage bull market, plus we broke out of the trend line. So that's why I'm longer term bullish, and that's why I'm looking to add on pullbacks when these things correct. JJG, this is a combination of corn, soybeans, and wheat. I pointed this one out for those of you that your head spins when I cover a dozen different agricultural commodities, all these different entry points, which ones are objective. Keep it simple. If you like corn, soybeans, and wheat, and they tend to move together, this is one for you. There, I just gave you an uptrend line there. It's a strong looking chart, but I just showed you soybeans. So if soybeans gets checked, then what that means is this is probably a momentum fueled overshoot of 4350, because if soybeans drops, corn and wheat could continue up, but it's going to offset some of that somewhat, so keep that in mind. But again, it's nice thing about it, you're diversified, and maybe maybe two of these are going up at any one time and one's falling, so you do have that benefit of diversification. It's not as diversified as the S&P 500 or SPY, or a broad-based commodity fund, of course, which I'll get to in a second. But again, if you want to target the grains, there's one for you. Uptrend line to watch, 4350 was a target. That's also support. So any break below could give us a correction. That would be your next objective buy point, 4160. Or we continue on up here to the next target zone right there, about $46. WEAT, again, one that as many I'm looking as a potential bottoming play. I see what appears to be a big basing pattern right here, and that's it. And we've had a lot of trades on wheat. We keep buying it down here at these lows right here, this very good support level at the bottom of the range. And this has been a wash, rinse, repeat kind of trade. Come up here, hit the top of the range. That's still where my fourth target is, the top of the range. I still think wheat's going there. So far, so good. The last time around we had nice bullish divergence here, positive divergence. Ran up, hit our first target right there, went on up, hit our second target, had a correction, reaction off T2, and put in a higher low. This is an uptrend right here. A security making a series of higher highs and higher lows so far. We broke a minor trend line that triggered the correction, but a big impulsive move up in wheat. It's not Tesla or some high flying tech stock, but a 2% move in ag commodities is a pretty good move on any given day. So next targets there, 574 and then 591, and I most open to adding additional targets and looking for a breakout again above that trading range, because then that will most likely mean we've started a new bull market, and then this is something you just tuck away for a few years with the appropriate stops in place, or you manage, you buy pullbacks after corrections and maybe get out when the charts are telling you a correction's likely. It's what I call micromanaging a longer term trend trade. Okay, a few weeks back I started harping on corn as one of my favorites, only because it looked the worst, at least to some eyes. It had underperformed. Wheat and soybeans had been moving up, as I showed you, and corn, for whatever reason, was underperforming and lagging. It was down here, kept testing these lows, putting in strong divergences, and finally, as expected, it played a game of catch-up. It's up about, nothing huge, but about 13% or so since that divergent low. Trend line was already hit. That was T1, T2 is up here, T3, T4, and big thin zone right here, meaning there's not a lot of resistance, because there was a big important support zone there around that T2 level, and relatively swift drop. So what I'm seeing here is this little, oh gosh, I'm messing that up. I'm trying to box that in. There we go. Into this trading range, and it's breaking above it. So if we can continue on up and not break this trend line, fall back within the range, which is a possibility, and I showed you soybeans to it resistance, but corn could just continue to play catch up while maybe soybeans corrects in time or price. Either way, that's next target. And corn, JO coffee, we hit the potential third and final target. That was entered back here. We had, this one's also been just a great trading vehicle. All these, look for these divergent lows right around this level, divergent low, go long, hit these targets, divergent low, boom, boom, boom. Last time around, we had a clean downtrend line. We had positive divergence right here, divergent low. We broke out, set a small wedge there, and boom, that was, I think, the last entry on our official trade. And boom, hit T1, hit T2, ran all the way up to close to that potential third target, had a correction, and then just hit it the other day. And after we hit it, you can see this is an example of why you might want to exit on a final target. That's where the risk reward is usually not very favorable. That's why I often list final targets on trades. T3, and not only that, but you had a clean uptrend line, well defined, and negative divergence. I can think of fewer reasons not to either, just like the one I was talking earlier, soybeans, whatever that was, not to at least tighten up stops and or take profits. And see, once it broke, when you get these overheated trades, it's been a big run off the bottom on coffee, that move, and what was that? Now I've just moved. Now I just changed that whole, whatever, that stop's no longer in play anymore. About 40% off that low right there. And this is a crowded rush for the exits, but we pulled back to support that former T2 level, and I think that's it. That's, divergent high, could certainly fall more, but that's probably it. I'll have to study the charts of coffee futures to tell you, but I think that's it. And it's not a super well-defined support level, but there were enough reactions there in the past where I can say maybe an objective long entry, albeit somewhat aggressive. It's an impulsive downtrend right now. Stop a little bit below. And if we take that level out, maybe I'll revisit it if we get down here. But I think that's it, and I think coffee looks longer-term bullish. NIB, Cocoa, ETN, this is my busy chart. This is a clean chart. And this one has just been a beautiful trade. I pointed out this uptrend line here, saying this was an objective entry. We had positive divergence and a pullback to that uptrend line right there. And that was our last, not our last objective entry, but it was highlighted as the, an ideal objective entry. And from there, we rallied about 32%. Along the way, we set up a little bull flag pattern right there. So you had an initial leg up, a little bull flagging action, consolidation, followed by another pop above. Where does it go from here? I still think it works its way up here to that 3490 target. That's final target, final near-term target. But again, I'll get to the video's getting a little bit long, but I'll roll into long-term charts very fast. But that's the big resistance, And again, this one has all the early makings of an uptrend. It reminds me of the chart, the weekly chart of gold. If you early in the year before gold broke out, gold was making higher lows, but it was bouncing along the same levels to the upside. And when it finally broke that level, it really ran. So that's kind of longer term outlook for cocoa via the NIB ETF. DBA, I pointed this out as if a one-size-fits-all ag commodity ETF. So if you like ag commodities, you don't want to go through the dozen or so I just spent that time on trying to micromanage the ins and outs. Here's your ETF, DBA. It's an ETF, not an ETN, so a little more safety there. Cattle, soybeans, sugar, corn, cocoa, wheat, coffee, hogs, cattle, and cotton. Everything I just went through. Pointed that one out as the same thing for months there. You had a little basing pattern. You had a bullish falling wedge or a downtrend line that broke out, and that set us up in this little basing pattern. Once you broke out above the basing pattern, that was another objective entry, as was the back test of the top of the trading range, and it's been moving up steadily since. So this is one that longer term I'm looking for more upside, at least to this blue uptrend line, and quite possibly more. GCC, if you want all commodities, not just the ag commodities, that's your one. You've got softs, grains, precious metals, energy, livestock, industrial metals, natural gas, you name it, it's all in there. Even gold, heating oil, all that good stuff. Coming up to a lot of resistance. What I think might come under pressure is crude oil here, and but either way, I just want to update it. There's the another uptrend line to watch. There was a minor uptrend line break. Just a lot of resistance up here that it's starting to approach right now. Okay, the video's going a little bit long. It's at the 36-minute mark, so I'm just going to look at this long-term chart of coffee and use that as an example, because on each of these, if you're new to the site or you watch these videos going back for months on the commodities, I've covered in some of those videos, I covered these longer-term charts. Not a whole lot has changed even for months now, and so you can click on any of the symbols below this post, like $COFFEE or JO for the coffee ETN, and it'll take you back to all previous posts covered there, and you can find some longer term charts. Maybe I'll do another long-term update soon, but the bigger picture for coffee is these, I look for these divergent lows on the weekly. This chart goes back decades. Here's the late 90s right here. There's the year break 2000. And you had a steep downtrend line. I always say divergences are not buy signals, whether they're positive or negative divergences. You look for the divergent lows and highs, and then you look for a sell signal such as a breakout of a uptrend line, which we had right here. That started this up to this point. It was a 294, we'll call that a 300% rally or bull market, and before all is said and done, coffee rose from that point 621% right there. However, along the way, there were tradable trends. That's what I talked about earlier, of micromanaging trend trades. You look for also these divergent highs, negative divergence, and then once you get the negative divergence, you had a very clean uptrend line. So at that point, it said, look, exit, and it was a swift drop, and you sidestepped that. It was well into a double-digit drop, and it pulled back to support. So that's it. Divergent high, correction. Divergent low, bull market. That bull market was 125%. And most recently, we put in a divergent low. At the time, I predicted there's another target I have up here. I forget the percentage. It's measured out. It's covered by this thing here. But I was calling for moves up here. First a 60% rally, then a 90% rally, and then whatever it is 100 and something up there. And we did that. We hit after the breakout. There was a bullish falling wedge. There was our objective long entry. We hit my first target. At the time, we were in the JO as a coffee ETN as a trade. Mentioned pullbacks likely, had an uptrend line, and that was it. So reaction off the first target, we pulled back. We put in a higher low. That was just a corrective wave, and so this is again where I showed you some near-term bearish developments. I think earlier on JO. Longer term, I think we're coming up here next to this target here, about 170, and that would be, from this point back here, wherever it was, that would be a 90% gain in coffee. Again, we already milked that 60% run. We milked this run recently, and I think there's more if you're a longer-term investor. Again, going off the historical returns from these, divergent low, 125%. 200 and almost 300, and if you really measure to this part, it was a total of about 627%. So that's coffee, and I strip away all the lines, and you can look at it this way too. This is pretty big support right here, this area here, and we had a little whipsaw false breakdown, bear trap through it, and we've held it successfully since. So bigger picture, if we can hold above the $1 price range, ideally, since we've tested it so many times, I want to see coffee start to move away from there and move on up to that next target. All right, guys, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.